have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets. Where's the gold?
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. So pleased to be with you. Thanks for tuning in. I have my co-host Brian London with me today, and we have a lovely repeat guest, a longtime friend of Gold Newsletter, Gwen Preston, and she is the founder, editor of Resource Maven.ca. She has her own newsletter, and you can follow her on Twitter at Mining Maven. Gwen, welcome to the show. And as we were just chatting about before we began, you mentioned this big topic, the Green Revolution, and what wisdom we can tease out of this to our advantage. So it is a big topic, but you seem to think this is what will drive, let's say, a recovery or long-term opportunity.
Absolutely, yeah. Thanks for having me on the show. We're in a pretty crazy moment in the markets, in our sort of monetary world. This exact moment, it's very difficult to understand what's going to happen tomorrow, in the near term, right? So I am not trying to make near-term bets on what's going to happen with the price of copper, the price of gold, the S&P, the NASDAQ. I don't know, because this is the moment that we're in. It's a very uncertain, volatile moment for lots of reasons. And we could talk about that at depth as well. And it's very interesting. But when you can't make decisions about the near term, yet you want to have your portfolio, positioned in general, then you have to take a little bit of a step back. And when I take a bit of a step back and look more medium term, my thoughts are, okay, once we get through this moment, which is this dramatic tightening by the Fed to fight really strong inflation, we don't know how that will play out, whether inflation will stick around, whether rates will stay high, but we'll get through this moment, which is the obsession over the Fed and things like that. Out the other side of it, what are the opportunities? And I think for someone in my position who's interested in metals and mining, the most clear opportunity is the paradigm shift in metals demand, in like green metals, base metals demand, that the green revolution is driving, right? Like the copper is the PhD of metals, right? It's known as, because it responds so clearly to growth versus contraction. It's this big liquid market. So people use it to bet on, the direction of just global economic growth. But what's like copper demand is just going through the roof because of the green revolution. I mean, electric vehicles are a big part of that, but of course, moving energy in different ways, all of it requires copper. And we are, in 2 to 3 years, facing the largest deficit in the copper market that there's ever been. You cannot have growth in the world without copper. It is not fungible. There's no alternative. And because we've just been through this period in mining where the fallout from the last bull market, which was badly managed by mining companies, has led to very conservative approaches among mining company management. So that has them reticent to spend money. Permitting of mines is such a long process now that is also slowing down the progress towards new mines. And then just overall sort of uncertainty. All of these things come together to mean there's been no supply response to the fact that we are going to run out of copper in 2 years. It sounds like I'm being hyperbolic, but I'm not. This is actually the scenario. And so when I see that, a huge market that's necessary for growth, that is directly tied to the green revolution, which is a huge force driving investment money these days, and where there's a dramatic shortage that cannot be fixed in time because of those permitting timelines for mines. I mean, that's the only answer, is dramatically higher copper prices. Copper is one of the examples, but similar things can be said for nickel, for silver, for uranium. So there's just a very clear opportunity for me in those metals once we get through this storm. This storm is still going to push copper prices down when, on bad market days, because that's the way that copper's always been traded. But once we get to the other side, I just think that the opportunity in these metals is dramatic. So that's what I'm thinking about. I'm not necessarily buying stocks today for it because of this near term. I think we're going to go down farther in the markets, but I'm really figuring out what I want to own coming out the other side because I think the opportunity is very real.
Gwen, as usual, we're just so simpatico in our views. I totally agree with it. And all I can really do is kind of restate what you said. It is amazing, you know, when you look across the whole suite of metals and minerals, uranium through zinc, through all the base metals, all commodities. It's this classic cyclical nature of commodities, underinvestment in exploration and development for many years, then hits an upswing in prices and demand, in the market therefore can't respond. And it takes, as you know, around 15 years from a new copper discovery to get into production. And even a known copper discovery is probably closer to 10. So it just takes a long time and there is no response. You know, I was, when the suite of conferences we were both at the week before last, one of the speakers was saying, and I don't know how accurate this is, but it's generally accurate, that there's about 40 copper projects out there that have known resources of over 500 million metric tons of ore. And that, so you look at this supply, I mean, copper is easiest than all the other base metals because you know it has to be used for their windings in the motors, the delivery of electricity, et cetera. You can change battery chemistries, risk and everything, and opportunity there. But copper, you know, is going to face this big supply crunch. It's hitting the biggest demand curve of possibly any commodity in our lifetimes. So you look at those 40 projects thereabouts that are out there identified, and normally you would say, okay, which one of those are likely to get picked up? And this guy's point was, they're all going to get picked up. They all have to be. Yeah. And even if you take all of those, it's still not enough copper. So that you're going to have this just tsunami of needed development coming up, and that any really decent near economic copper project in a somewhat stable regime is going to be an opportunity. But then again, when, like you said.
Yeah. No, I agree. And one of the really interesting things about the copper market is that it is it's not very forward looking. Despite being the PhD of metals, you would think that that moniker would suggest, you know, some sort of vision, but it doesn't have vision. It's very immediate. It always responds to like a strike at a mine or, you know, COVID lockdowns in China restricting demand over the next quarter. And yes, fair enough. That's the way that market works. It's a very immediate market. But at some point, at some point, like, don't you need to look ahead? And I've been thinking about this a lot lately, and I think we're actually going to need to get to the point where we're basically running out of copper, like where copper users can't get their hands on copper that they need in 6 months, like that sort of time frame, before everyone goes, oh my, wait, it actually happened. We have to be forward looking. And then I think the response is going to be really dramatic. Like, and it's interesting to say that we're already at very strong copper prices, relatively speaking, but I think we're going to get like way stronger from here, like $7 copper, $8 copper. I really think we're going to need to get to very high prices because there's been no supply response. An analogy for the amount of demand increase is obviously the rise of China in the 2000s. But what's interesting is when that was happening, the supply response was pretty quick. Management at mining companies were like, okay, we see this coming. Let's build mines. You know, they weren't super conservative. They were more opportunistic. And permitting of mines was much faster. I'm not saying that that's necessarily better. It's just the reality. And so there was a supply response. In 2004, they were like, okay, let's start building mines. And supply came online as demand rose quite rapidly. But we just haven't seen that this time. So it's just like these things are just coming together and there's only one response. There's only one outcome, which is much higher prices when it all happens.
Yeah. And China is an interesting part of it. You know, back then, China was experiencing double-digit growth rates in its economy. And now it's, you know, half or a third of where it was as far as growth rates. But the Chinese economy is 5 times larger.
Exactly.
So it's still going to be a factor going forward. And you have all these other factors added on top of it. Yeah, the timing is the issue. And one of the points I've always made is that you can go buy a copper producer right now or copper development company or explorer, but you better be ready to hold on to that for 3 years or so before you really get this upswing. Because what you really need in copper and all these other metals is a bull market in gold and silver to get the junior mining sector energized. It's really hard. I mean, if you think back about uranium mania, the rare earth mania, even copper and everything else, those all had the backdrop in the 2000s of a really buoyant gold and silver market that got everybody into the sector, all excited. The casino was full, and then they started looking into all these other metals, and you had the response in the junior mining stocks. Do you think I'm right? Let's put it bluntly there.
Yeah, I mean, this is another thing I've been thinking about a lot. And the fact is we've had a pretty good gold market in terms of the price of gold for the past 5 years, right? Since things, I mean, okay, not really in 2018, but whatever. Gold has done well, especially since COVID. Gold has done very well. But gold stocks have not. They truly have not. They've had their moments, but really they have not given the leverage that we would have expected based on historical patterns relative to the gains in the gold price that we've seen. So what's going on there? I mean, my concept is that the whole Fed backstopping the stock market, which it did with the great financial crisis, and then of course it tripled, quadrupled down with COVID, and just backstopped the stock market, that created this abundance of risk reward, high risk, high reward opportunities in the stock market. And I think gold used to hold that space more dominantly, right? Gold was, if the market's going, okay, there's risk because it's exploration, it's development, there's all these things to do with mining that are risk. But when they work, man, do they work, and they hand out rewards that like people remember. Except that now there's this like abundance of things that hand out, not right now, but until we got to this tightening cycle, there became this abundance of high risk, high reward things. In fact, the risk factor hardly existed because the Fed was backstopping risk. And so like you could buy whatever and it did really well. So I think that has really over the last few years, that's changed the motivation for people to invest in gold stocks. Like it just diluted it is perhaps the best way of saying it. And so going forward, is that going to remain the case? I think that will depend primarily on what the Fed does from here. If the Fed steps in to rescue the stock market or is perceived to step in to rescue the stock market as it goes through this tightening cycle, where it is nominally supposed to be focused only on inflation and unemployment, if there's a perception that it steps in to rescue the stock market, then I think, gold and precious metal stocks will remain in that struggle, because that idea that, oh, the Fed's backstopping the market again, we can go buy monkey NFTs and we're going to be good to go, right? That will come back. But if the Fed doesn't step in to rescue the stock market, maybe we would revert back more to a more, call it fundamental stock market that doesn't have this Fed backstopping risk thing going on. And then I think gold and silver stocks could step back into their more traditional role of offering that opportunity. And I think if you step a bit farther back, that also just relates to the gold price. Like the gold price moves based on economic and monetary cycles. The Fed interrupted those, right? And if the Fed continues to interrupt those, it just changes the market. But if the Fed steps back on interrupting those so significantly, then we can have more of the regular cycles that we've had. And then I think we have a better chance of having our gold and silver juniors, step forward and lead that charge again. So it really all depends on what the Fed does over the next 6-8 months, which I hate because I am so tired of waiting to see what the Fed does and that being like the thing. But I really think that's where we are right now.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
This is the Inventa Capital Mining Update, and I'm pleased to have Leo Hathaway with us today. He is with Golden Shield Resources. Its ticker is GSRI on the Canadian Securities Exchange, and its website is goldenshield.ca. Leo, welcome. I know you've got lots of news. You've had 2 press releases out this week. So do you want to discuss both the results and your new financing strategy?
Yeah, so we put out the second round of drill results, actually part of the second round of drill results on Tuesday. We continue stepping out on the Mazoa Hill target that we drilled before in phase 1. Phase 1 drilled 50 meters at 9.1 grams gold. We stepped out on that with hole 21, and we about 58 meters down dip and drilled 31 meters at 7.58 gold. So we have the high grade zone that we're stepping out onto depth. We had a number of other good results in that first batch of the second round of drilling as we step out, and we still have another 5 holes to come from the second round of drilling.
Yeah, and so do you want to say how that squares with your expectations and whether the market has responded well to these results?
Yeah, so they do meet our expectations. In fact, we're really pleased. You know, it's nice when you step out on a high grade zone and it keeps going. So
right.
we're very happy with that. The market did respond. We were up on the day of that release, about I think 20 cents from the low 50s to the low 70 cents. We've come off since, but we did decide to launch a financing, as you mentioned.
Right. So that, yeah, do you want to clarify what that financing is and whether that has softened that share price with a slight dilution? Yeah.
So we're issuing units comprising a 55 cent share and a half warrant at $1, and we plan on issuing 8 million units.
Okay. And is now a good time to get on board? Should people be, I mean, is there more information coming out?
Well, I would say yes, and the reasons for that is at those prices, the market cap of the company is around $16 million. So that is, you know, really cheap given the results we're putting out and the team we have. I would say, you know, on a comparable basis or just on a as a straight value proposition. And as I mentioned, we do have more results coming from this second phase of drilling in the relatively near future, and then we will continue work at the Marudi Mountain project, and we'll be back drilling shortly. And in the interim, we'll be trenching and getting the other targets on the property to drill stage, as well as generating more. So news flow will be pretty much constant. There's more drill results coming, and they'll in the short term, and there'll be more drill results coming in the medium term as well.
And is there any update on the over-the-counter option for Americans?
I believe that's about 3 or 4 weeks away.
Okay, perfect. Yeah, so folks, goldenshield.ca is the place to go, Golden Shield Resources, and the ticker on the Canadian Securities Exchange is GSRI. If you want to follow my Twitter, @FergHodgson, I'll release a note, and so they, of course, when the over-the-counter ticker is available. Leo, thanks for your time.
You're welcome.
Yeah, I would say that's exactly what drives all the markets is monetary policy and the Fed. I'm probably a little less pessimistic than you because I think that the Fed, more money, easier money will always help gold, we have had that competition with stocks because the average investor today plays the options game and leverages and gets junior mining discovery kind of returns from, you know, betting with the Fed in the general stock market and in the tech stocks, et cetera. One of the big factors I see is the fact that gold just hasn't been able to sustain any upward momentum because the market kind of looks at, you know, not where the price is, but where it's going. So we'll get up to $1,950 or thereabouts, or even over 2,000, and then we'll drop right back down in a flash. A lot of that has to do with the paper market games that are played, you know, the price being set in New York. set in New York. But, I think we just haven't had that kind of a sustained market. Even a couple of months of sustained gains seems to wake this market up.
It's true. And I mean, when we did have a few months of sustained gains, there's been periods of that over the last 2 years.
Yeah.
And it's true that the gold majors did leverage that in those moments. But then when the gold price lost its momentum, then, it sort of redoubled back on the downside for the stocks. And it is, as we get through this tightening moment, this storm in the markets, I mean, what's going to happen on the other side? I don't know. I had some long conversations on Friday with our good friend Eric Coffin, trying to figure out whether inflation is going to come down. And that's sort of a big question, right? I mean, the Fed is 100% focused on headline inflation. For better or worse, that's what they're focused on right now. Is it going to come down? I can argue myself blue in the face both ways, honestly, because there's obviously supply bottlenecks, and there's just so much money that's been pumped in. Like, the modern monetary theorists have a point. Well, those who argue against MMT. Anyways, so much money has been injected, and that money is moving around the economy. So I don't know if tightening is going to work. And that matters because tightening, I think we're going to go through some tightening, and then I think there's going to be a pause on tightening. And I think that will be an exciting moment for gold. And I think that will probably happen later this year, if not early 2023, because even the bond market is saying the Fed isn't going to be able to do as much tightening as it thinks, which is a big change, because only a few weeks ago, the bond market thought that the Fed was going to do more tightening than it said. And now it's like, okay, now the Fed is getting a little ahead of itself. So now it thinks it's going to do less. So that's interesting. And I think there will be a pause in tightening, in the next sort of 6 months type time frame. But then the question is, what happens to inflation then, right? Does it actually turn down? Does it waver and come back? What happens? Because that will determine whether we end up in, a recession, a stagflation, or a return to some sort of balanced economy. And that'll really have a huge impact on the gold price. I mean, gold arguably makes sense in several of those scenarios. It definitely makes sense in any inflationary scenario. And if there's a weak economy, then it becomes one of the only things that works. And so that can really help the gold price. But there's so many questions out there about what this tightening cycle will actually do to inflation. It's clearly pulling us into a recession. We're being tightened into a recession. It's just a question of whether inflation actually comes down during that recession.
Yeah, I think inflation's coming down. I don't think it'll get much below 5 or 6%, because we still have wage gains coming through the pipeline. We still have rents coming through the pipeline, and still more supply disruptions. I don't think the Fed can fight inflation or really kill it off unless they get the nominal interest rate above the rate of inflation. And there's no way they can do that. I mean, even if they get the Fed funds rate up to 2% or a little higher, the cost of servicing the federal debt now, which is 3 times larger than it was in 2008, are enormous. And I think that's the wall they run into. I'm looking at late summer, early fall. I mean, they're already up at 1.75% on the Fed funds rate. I think they've only got a 1/4 or 0.5% more before they start really feeling the pain of rising debt service costs.
And I mean, that's true in the corporate world too, right? Corporate debt levels are very high as well. And so it's not just a matter of, I simplified it a bit earlier in our conversation saying is the Fed going to ride to the stock market's rescue? Well, it's also riding to the rescue of the economy at a point, because the debt service costs become prohibitive to growth. And so, just in the same way that it becomes impossible to service the federal debt. So yeah, it's really, may we live in interesting times.
We have for a while, haven't we? But that's another good point. There's a lot of zombie companies out there that can't survive at higher interest rates. So that's one way to kill off inflation, by killing off the economy and throwing it into a deeper recession, even if you don't get nominal rates above the inflation rate.
Yeah,
that could be
sure. I mean, that's sort of, unfortunately, the Fed, for all of the talk that we do about the Fed, they are armed with only the bluntest of tools, right? Tighten us into a recession. That's literally their option for inflation.
Yeah. And they have a lot of tools they seem to pull out and invent when it comes time to ease money. So the next crisis they have, think about that. They have to do more than they did, in the COVID crisis. And COVID, they did so much more than they did in post 2008. So what are they going to come up with next? That'll be interesting.
I mean, a good example of that was 2 weeks ago when the European Central Bank met, and they're like, okay, we really need to raise interest rates. Inflation is getting serious. And then we had this crazy disparity in yields between the have-not European economies, right? The Italy and Greece. And poor Greece was just getting its feet back under itself. And now its bond yields have gone through the roof. And like, that's a very challenging situation for a country that still has a large debt load versus, you know, Greek bonds, or German bonds, which remain, you know, the strongest. And guess what? That is the disparity that almost broke the EU back in the Great Financial Crisis, or in the years following the Great Financial Crisis. And you know what? It hasn't actually gone away. So they're like, we have to raise interest rates. And then we had this yield disparity. And then the ECB convened its emergency meeting. And the result of the emergency meeting was that they said, we have sent our people back to find a solution and we will tell you when we find it. And you're like, but we tried that a decade ago and you didn't find, okay, I'm glad you're talking about it. So this is just an example of they have very few tools when it comes to the tightening side of the cycle. They can come up with all kinds of creative things for the loosening side, but the tightening side is just like, it's tough.
Yeah, well, Gwen, I want to bring you back to the more specific talk. I mean, we talk about the Federal Reserve all the time. I mean, it's, as you said, it's so central to our discussion. But Brian mentioned, you know, the different levels of companies you can focus on, you know, explorers, developers, producers, and you mentioned copper and then other related resources. Do you have a focus there? You said that they basically need to be more explorers. They just aren't. Is that the situation? I didn't quite understand your conclusion there.
So, I mean, we need more production of, I mean, the ones that I like to list as my 4 key key green revolution metals are copper, nickel, silver, and uranium. Those are the 4. They're medium to large markets. Their supply demand fundamentals are very bullish. They're not tiny little markets where it's hard to understand what's going on. So those are the ones that I gravitate to. And I mean, on the silver side, Chen Lin, another good friend of ours, he has a great run through of solar panels, and solar panels are obviously a very big driver of the silver market. Currently, they're about 1/9 of the silver market. But they are expected, if we follow sort of the International Energy Association's projections for what's going to happen with solar energy over the next, I can't remember, 5 years, I think, then silver panel usage is going to go up almost 9-fold. So that would take up the entire production of silver on its own just by the growth in solar panels. But at the same time, China, which is clearly the dominant power in the technology and manufacturing of solar panels, also is like doubling or more the amount of silver that they're using in each solar panel because they're getting that much more energy out of each panel, so it's worth the extra cost. So even if they weren't using more silver, it was already going to use up the whole silver market. But they are using more silver, so we're just dramatically short on silver. And you can say the same, you can go through very similar numbers with uranium. Uranium's a bit more complicated because there's all these holders of uranium, but still I'm very bullish on uranium. There just isn't enough to meet the demand that has been rekindled by Russia's invasion of Ukraine, which of course has reminded everyone that nuclear power is a very green choice and also a non-Russian, a choice for Europe that is not reliant on Russian oil and gas. That works. And then nickel, I mean, a famous quote from Elon Musk is like, there isn't enough money in the world to create the nickel that we need by 2024. Like it just, you can't do it. All the battery technologies that Brian referenced, they could all just be called nickel batteries because like all the chemistry is detailed, but what they are is nickel batteries. So for all of those metals, what we need is for the investing public to get interested. Because the investing public hasn't been particularly interested. They were very distracted by a buoyant stock market. And fair enough, if you can just own stock market funds and get very good returns, then why would you worry about investing in uranium or silver? So there's not been investment capital. There's not been interest from major there's been a very conservative approach for major miners. And of course, building mines has been very slow. So there's been no supply response. But we need investor interest to turn in. And I think it will, almost no matter the details of how we come out of this economic moment, because the green revolution isn't going to stop regardless, no matter what happens with tightening and inflation and all of this stuff. The green revolution, I don't think, is going to stop. And so the paradigm shift in demand for these metals, silver demand going up so much, nickel demand going up so much. I mean, the nickel market is doubling, right? These aren't going to stop. And so investor interest will turn in. It might take a year. It might take 2 years. It might take 3 years. I'm not sure. But when it does, there's going to be opportunity across companies. So from junior explorers through developers to producers, which is cool because those who are interested in getting exposure to that opportunity, if you want to be very involved in your portfolio, then you can find the explorers that you think are going to make a new discovery and get the most potential leverage on that opportunity. And if you don't want to be super involved in your portfolio, then you can buy a producer and you can just have good, solid leverage to a copper price gain, a silver price gain, whatever it might be. So you can, there's opportunity there for all kinds of investors. And it will happen across the spectrum. It's not going to happen tomorrow because we got to get through this moment and see, interest. The market has to be paying attention again. And right now the market is only paying attention to turbulence and Fed funds and inflation and all of this stuff. When the market can look outside of this cloud, then I don't see an option other than for them to pay attention to these opportunities in metals.
Gwen, you mentioned the spectrum of opportunities in mining, from junior exploration through, development, and then the producers. The classic way it works is that big time investors, generalists, get involved in the producers to leverage gains in the metals. Then they start looking for more torque in their portfolio and go on down the food chain and eventually hit the exploration stocks that we like to play in. But this time around seems very, very similar to 2010, 2011, when while the gold price was going up and the silver price was soaring, the oil prices were also soaring. And right now we have very high energy prices, very high oil prices, and particularly very high diesel prices. Even the diesel prices, they imply a much higher oil price than we're actually seeing right now. And it takes a lot of diesel to move those big yellow trucks, and we're getting margin compression that we have not yet seen in the quarterlies, where we're about to see the cost of production really rise and those margins compress. Is that what we're going to see again, where people are going to start shunning the producers in favor of the metals, or in favor of not even investing in the sector at all? And is that a danger to the juniors?
I mean, it's a really interesting point you raise. To start with, it's a bit depressing because over the last few years, I think you and I and others have pointed to gold producers in particular, but also copper producers and whatnot, and been like, oh my gosh, they are printing money. Like, yes, they're making so much money. How is the investing public not paying attention to this? It's insane. And now and yet they didn't pay a lot of attention because of everything else, all the other opportunities that were out there. And now those margins are being compressed. And so that big attraction is like diminishing because of inflation. And like you say, diesel prices being a leading cause. Yes, for sure that will be a factor. And I do think that when we get to the point where people's interest pivots back to metals, precious, non-precious, whatever it might be, it's possible that developers might get the first sort of foray of attention. And that's relatively speaking. There's a lot of big funds out there who would only ever invest in a dividend paying stock. And of course, developers never pay a dividend. So there's a lot of money that can only go into the majors. So it's not like the majors are going to be shunned, completely ignored. But I do think that there will be some preference for the developers, especially just given this big context that we're talking about, which is that we need more production. It's not just that like demand is really ramping up and because China's growing like it was in the last major bull market. It's that we don't have enough production. So that very clearly sort of points to developers as the obvious opportunity. So I think you have a good point there that when attention turns, developers might get an unusually large share of that attention. So I think that's a cool idea to pay attention to as we look at what to position in on the other side of this mayhem.
I agree. And, I'm telling people, they ask me if this is the bottom. I'm not sure it's the bottom, but it's pretty close to a bottom, and I'm not telling people to jump in head first yet, but, wait in a little bit, accumulate some irresistible bargains. But, hopefully the seasonality of, mid-July to early August reflects a bottom, and we're probably getting pretty close.
I think so. And I think in particular for precious metals, I think we might be the base metals, because like I say, copper is such a reflection of the global economy. If the stock market, if we do get more recession indicators, which is almost guaranteed, and the stock market slides further, then I think some of the base metal stocks might go down a bit more just because they are such a clear reflection of growth. Even though I don't think that makes sense, because I don't think it incorporates any vision. But what I think doesn't matter. That is what it is. So I think the base metal stocks may have more downside yet because of that, because of the recession that's coming. But I think the precious metals, we may be pretty close to a bottom, because gold has actually done very well. Like you say, it's been sideways, but that's better than down. It's actually held its ground quite well. So I don't think there's a lot more downside in the precious metals. And like you say, summer is traditionally the quiet period. And so, spending some time thinking about what you want to own, picking things up, before we get to the fall, when most of us think that tightening, whether they actually start cutting or whether they just say, okay, we got to hold off on the tightening before we, cause an insane recession. When they say that should almost certainly cause a rally in gold stocks. So yeah, I think on the precious metal side, we're dancing along the bottom, perhaps. Is dancing a good word? Dancing implies happy.
That's a great way. People also dance along the edge of a precipice too, but
true enough. I'm scared of heights, so I don't.
We'll take the more positive metaphor for now.
Yes.
Thank you so much for your time, Gwen. So you can learn more about her work and get more specific recommendations at resourcemaven.ca, and you can follow her on Twitter, Mining Maven Gwen. Thanks for your time. And Brian, I look forward to next week.
Thanks so much for having me. Great to chat with you always.